Hello there. How you doing tonight, Sydney?
Hi, how are you doing?
I'm doing better.
I'm sad to hear about your arm.
Yeah, me too.
That's such a bummer.
Bummer. Yep.
I
Well,
actually happened to miss last week and did never see another video posted. Do you have a video from last week?
I didn't, and I realized because we got cut in the middle, I wanted to re-record it,
Oh, okay.
and then I've been working with our software provider, and we're trying to put together something better. So I didn't get another one. I've been lame. I haven't been at my keyboard much in the last 7 days.
Well, it sounds like you have a good excuse.
Yeah. Well, everybody's got excuses, but
Oh, what a, yeah, that's hard. Well, I'll look forward to it when it comes out.
terrific. Can you see my screen already?
I sure can, yeah.
Okay. Well, let's get started. So, I had planned originally tonight to go ahead and do a deep dive into our software, but I was working until 9 minutes ago with a software provider around passwords and file sharing and all kinds of stuff, and I just think we're going to be better off if I give them one more week to get everybody ready. And at the same time period, I thought everybody was kind of on the loop, so it's like, oh, Tuesday night we're ready to go. So it looks like you, but so we get into. So I think it's important, and we can have a conversation along the way about this. So I think it's important that we have a bookkeeper's vocabulary, that we understand what entities are all about, we understand accounting terms, financial statements, what those are, some tax accounting, and allowable expenses and special expenses, and what we do about that. So that's what I intend to cover quickly tonight. It's not like a deep dive, but the idea is to introduce it and then give you keywords and principles. And if you're not clear about it, you can look it up, you can watch some videos, you can do some other things. I always encourage people to kind of be, self-learners, because, when you're involved in the bookkeeping world, you're always going to be figuring things out and digging in anyway. So we might as well kind of do that here and not spend a whole lot of time in a way that people could discover for themselves. Is that fair enough? Make sense? Um,
Sounds good.
so in the idea of entity, if somebody were to say a business entity, does that have any meaning to you? Who can tell me what they think an entity means? What is a business entity? Anybody have an idea there? I don't see anybody. You can unmute if you'd like. I think you've all got the ability to unmute. Okay. So a business entity is like a sole proprietorship, a partnership, a limited liability company, a corporation. That's the entity. And so we use the term entity to describe what's the structure or shape of the business from a legal standpoint that you're operating. So the easiest, simplest, most common business entity is a sole proprietorship. So, or being a sole proprietor. So when you see a little kid on the street corner offering to sell some lemonade, that child is in business and a sole proprietorship already. That all you have to do is extend an offer for a good or services or purport that you're in business, and you are immediately designated as a sole proprietorship unless you do something more. So a sole proprietorship is a sole proprietor is referred to the owner, and can typically be called Bob, right? So Bob in and of himself, Sally, David, Joe, Mary, Juanita could all be sole proprietorships merely by offering. When gal comes up to my office on the street and she's offering to sell me a dozen wonderfully prepared, what do those gals sell? I love them. Burritos or something like that. I'm thinking of something else, wrapped in corn shells. But anyway, she comes. You got it. So when she comes to offer those things and I buy them from her, she's a sole proprietorship. She's already in business, off and going. Okay, so that's the entity she's in, is a sole proprietorship. The next entity that's pretty common is partnership. So if two kids are standing on the corner and they're not related, not married, and they're both offering to sell lemonade, then they're automatically, unless they've done something else, a partnership. So when Sally and Bob are selling a lemonade on the corner, offering for the sale lemonade, they're automatically partners. There's nothing they have to do to designate that partnership. Now, there's some things we can do to designate that partnership, but they are immediately a partnership by all kinds of different standards. Merely the fact that Sally and Bob offer lemonade together, they are a partnership. Okay. Now, if they're married and they're common, there's all kinds of rules about that are different. But we're talking about two non-related parties that decide they want to do some business together. The moment they start offering their goods or services or purporting themselves to be in business together, then they're automatically a partnership. And we can also do some things to that partnership. So a sole proprietorship is tax filed on the Form 1040 on Schedule C. The partnership is filed independently as a tax form 1065. And a partnership is filed as a separate independent entity. And then what happens is that independent entity gets reported on a K1. It's a Schedule K1. It's like a W-2 or a 1099 that you would get as a partnership shareholder, and that would report to the partner and to the IRS the income allocated to that partner or expenses allocated to that partner from the K1 from the partnership. Okay, so we've talked about sole proprietor 1040 Schedule C, owners Bob or Sally, David, whatever. Partnership is 1065 form, K1, partners are owned Sally and Bob together. Any questions about that? We'll move on. Any discussion? I want to remind everybody that I can't see when you raise your hands and that kind of stuff. It just doesn't prompt me here. So I apologize for that, but I'm focused on my screen and I don't see what you're doing. So, all right. The next type of business entity is a limited liability company or an LLC. Now, I'm old enough that I did business for years before the LLC statutes were broadly adopted across the United States. And so what we used to do is we used to form kind of exotic partnerships in order to create an LLC, and we'd stack them together. And finally, the state started allowing for the formation of an LLC, a limited liability company. But a limited liability company is a creature and creation of the state and is only kind of hat tipped by the IRS. So one of the things about a limited liability company is that if you are a sole member, if you're the only one in an LLC and you're the only owner in an LLC, unless you do something drastically different in the form of the way you designate yourself to the IRS, that'll be disregarded. Okay, so one of the phrases we want to have here is disregarded. Be disregarded by the IRS, and the IRS will look at you as if you're a sole proprietorship, and the money that's in the LLC account will be automatically assumed by the IRS to be in your pocket. Owners of an LLC are called members, and managers of LLC are frequently either members or managers, not president, secretary, and treasurer. Okay. An S corporation can be a tax election of either a limited liability company, could be elected at the IRS level as an S corporation, or it could be a corporation that has made an election to be treated as an S or a small corporation. The members of a corporation are called shareholders, and the officers are called president, secretary, treasurer, etc. Spell president correctly. Okay. And then a general corporation or a C corporation, they're also secretaries, presidents, treasurers, etc. It's the same thing. It's just that the difference is this. When you elect to be an S corporation, all of the income of the S corporation is considered by the IRS to be distributed to the S corporation owners. The S corporation owners get a K1 also, and they're filed on a form 1120. S. It might be 1120S like that. K1. Okay, so an S corporation's owners, they file a separate tax return. They get a K1. The shareholders are called president, secretary, and treasurer. But when you see an S corporation, a small corporation, the government gives a little bit of a break and makes it simpler so that all of the income of the S corporation drops into the pocket like a limited liability company owner. It's just that the S corporation is considered to be passive income, And there's an expectation in the S corporation that there is passive versus active income. And so all the income that is remainder to the S corporation at the end of the year is considered passive income. And the IRS puts a burden on the officers to pay a certain amount in payroll exposed to self-employment. Exposed to self-employment tax. Okay. So the reason I'm bringing up this vocabulary stuff right now is because I want you to feel comfortable when you're out in the field and you're talking with people and they say, well, I'm a C corporation or an S corporation, or I'm this, I'm a that you understand what they're talking about, that you know what an entity is, you know what the different types of entities are, and you have some level of vocabulary. It's important for your own confidence. Are most of these things essential for your practice? Maybe not. You're going to be primarily focused on bookkeeping, but you want to feel confident and comfortable in the profession that you have. And these are the key words and phrases that people are associated. If you get a business degree, you go to business school, you're going to be associated with these keywords and phrases, and I want you to have the same benefit. And then finally, the C corporations. What's interesting about them is that, the C corporation is going to have, they're going to have double taxation. And what that refers to is tax at the C Corp level and to the shareholders. Okay, so in the situation with the S Corp, if you made an S Corporation designation, then all the income falls out of all the net income falls out as passive income, and there's a burden on the leadership to produce some active income and do that through payroll exposed to self-employment tax. But in the situation of the corporation, there's no burden for none of the profits fall out. There's no burden for you to expose profits, but they're all going to be taxed. All profits inside the C Corp will be taxed on the 1120, no S, just the 1120 tax return. And all the profits will be taxed first at the C Corp level, and then again, when the shareholders receive distributions, they'll also be taxed. So you end up with 3 or 4 different kinds of distributions out of a C corporation. So what you have is the C corporation has taxation at its level, and then you're going to pay some officers and employees and directors, and they're going to have some employment tax on that, and then you're going to have taxation to shareholders because they've received benefit as shareholder, corporate stockholders, things like that. So I wanted to cover entities really quick. Anybody have any questions or discussion around entities? Can somebody unmute and just make sure that we're doing okay? Because you guys have been really quiet out there.
Doing good.
Okay, thank you, Sydney. Debbie, are you out here with us?
Yes, I'm here.
Okay, gotcha. Okay. Any questions at all about this idea of entities, what they are? I mean, I'm not trying to get too deep, but I'd be glad to answer your questions along the way. Entities, sole proprietorship, partnership, limited liability company, S corporation, corporations. Any questions about that stuff? Any comments?
Larry, it sounds like from what you said in lesson 1 that most of our clients will probably be sole proprietors or partnerships. Is that right?
No, I think you're going to be sole partnerships, limited liability, and S corps. I think you guys will be playing down through the S corp realm. I do.
Okay.
I would expect you guys to be. Thank you for the question. Sole proprietor, partnerships, limited. All these guys are typically going to be in that 0 to 300,000 income range. The reason these larger corporations, the reason C corporations come into being is typically for more advanced tax planning strategies, or because they want to raise a lot of money with a bunch of different shareholders. And so you'll see C Corps will be out raising, $20 million here, $10 million there, trying to get people to buy into their, new widget thing that they're doing. And they may have hundreds of shareholders, et cetera. So this is a game that you'll probably not be playing in, rarely, if at all. But I think we're going to be pretty comfortable in all of these areas. The bookkeeping is effectively the same. There's some nuances back and forth. They're maybe the same. Any other questions about entities? Good question, Debbie. Or excuse me, Sydney. Okay. I'm going to move on. Accounting terms: gross profit, gross, and net profit. Anybody have any idea what that means? What's gross? What's gross income? Somebody make a guess. What's gross income?
Before expenses.
Good. What before expenses?
have operating costs. It's the money that comes in before you are accounting for anything that cost you money to
Okay.
operate, right?
Good, good. Okay, so
Or
is that Debbie?
cost of goods sold, yeah.
Right. So Debbie says it's money that comes in before everything. Right? Well, that's a pretty good definition. Look at me, comes in. Hey, everybody, you got money, comes in. So yeah, gross income. That's a pretty good definition. Money that comes in. Oh, there's the sin still. Money that comes in before everything, right? So now we have this idea of gross profit versus net profit. Anybody have a guess on that? Okay, what's COGS?
Cost of goods sold.
Cost of goods sold. Excellent. So you got your gross income. That's the money comes in before everything. And then you have this gross profit. Gross profit are those things that it's an accounting and management tool and term. It is not a tax related concern. I mean, a little bit, but not significantly. That gross income minus cost of goods sold equals gross profit. So it's a way that a manager looks at a business and says, well, let's just see. I had $10,000 tonight in gross income at my restaurant, and it cost me $5,000 in food and production costs to make my food. So I had 10,000 tonight. Yeah, that's a pretty good night. But then I had $5,000 in food costs. That includes my food and direct costs associated with building it, with producing the food and getting it out to my clients. And so I end up with a $5,000 gross profit. So my gross for tonight on my restaurant was $5,000. Not a bad night on a restaurant. Okay. But that's not what the owner gets to take home, is it? Does the owner get to take that $5,000 home, or is there more?
There's further expenses.
Can't quite hear you there, Deb. Can you? Maria?
Turn that up.
There we go. Okay, so does the owner get to take the 5,000 home?
No.
No.
No, not yet.
Mics are going in and out.
Can you hear me now?
Yeah.
I would say no, because
Okay.
there's still further expenses.
There's further expenses. Okay, so what kind of expenses do you think we're going to see? Let's talk about that restaurant. What are they going to have?
We have to pay Larry.
Salary.
Got to pay the Larry, the accountant, right? So Larry, the tax guy. Okay, but before that, we're going to have lights, mortgage, yeah, insurance, right? And you're going to have things like,
Rental.
what's that?
Rental.
Can't quite hear you.
Rent. Rent expense.
Yeah, I threw that under mortgage, sure. Rent, mortgage or rent, sure. Mortgage/rent, right? Insurance.
Salaries.
What's that? Salaries.
Salaries.
And you got to be careful about salaries because some of those might fall under cost of goods sold, but you're absolutely right.
Oh, yes.
What other expenses would you expect to see in a restaurant that are not directly associated with the food? Advertising, right? Advertising. Let's just remove this. We'll just say accounting expense, right? Accounting, advertising, right? You got some, right? So you see, you got a variety of, you got a variety of expenses we're gonna have to take out of this, and after those expenses, we get the net profit, right? And the net profit is typically what the owners are excited about. Gross profit's good; it's an indicator, but then you've got these other expenses that come out of it. Okay, so some accounting terms: gross income, money that comes in before everything else. Good. Gross income is minus cost of goods sold that gives you gross profit. And your gross profit is before your expenses like accounting, your indirect. And sometimes you say direct expenses and indirect expenses: accounting, lights, mortgage, rent, insurance, salaries, advertising. Now the salaries associated with the cooks and the servers sometimes are pushed up into COGS, especially if you're a manufacturing firm. So you're bringing in, 2,000 pounds of uh, of flour and and sugar and such. Your salaries for those bakers turning that into bread would probably be part of the cost of goods sold. Okay, the net profit. Any questions about accounting terms on this page? Financial statements. Three primary financial statements: the profit and loss statement, called the P&L, your balance sheet, which assets minus liabilities equals owner equity, and your cash flow statement. I'll tell you that most of the time, you and I are going to stay out of the world of cash flow statements entirely. Balance sheets occasionally get updated, but your balance sheet is only required when you get into partnerships, S corporations, and corporations with significant revenue and assets. And I rarely have to worry about balance sheets, and we're not going to focus on that from a bookkeeping standpoint. So what we do focus on is a profit and loss statement. So, and it might be helpful for us to understand the order of each one of these. So a profit and loss statement is going to look like gross income minus COGS equals gross profit. And then this is where most of your work is going to occur. And then you're going to have some bunch of expenses here. I don't know why it's doing that. Trying to get it up here. You have a bunch of expenses. So expenses, which we just had, minus expenses equals net income. And that's the format of a profit and loss statement, of a P&L. Okay, that's what P&L is going to look like. Gross income minus cost of goods sold equals gross profit minus expenses equals net income. Eventually, you'll probably be involved in preparing profit and loss statements. It's typically what you're going to provide for your in-run client is something that highlights their income and their expenses. And you may not need to separate cost of goods sold, but there'll be some things that are pretty obvious for you. Gross profits you may calculate or not. Expenses you'll need to identify, and we'll dig into those a lot. And then the net income be excited. So these are statements that you're probably going to be generating quite often for your clients, monthly, quarterly, annually, and we'll get you comfortable in that world so you feel like you're there. A lot of this work will be done for you with the software as well. And then next statement, balance sheet. So balance sheet. Balance sheet is going to include the assets minus liabilities equals equity or owner equity. You'll hear it said in either way. So balance sheet is typically pretty short unless you've got a whole lot of described assets and a variety of liabilities. Your balance sheet could often be, 10, 12 lines, but it's going to be a statement so people understand what they own and why they own it. I just, Monday, I don't know what today is, today's Tuesday. So yesterday I helped to draft a purchase and sale agreement. Got some clients that they have a very interesting business model. They raise very unique little creatures. And they decided to buy out a competitor that is also raising really unique little creatures. And so we had a balance sheet that was, we were describing the assets of this company, and the assets were all kinds of different little creatures. And I don't want to share too much about my clients, it's all confidential, but it was fun putting that together. So we used the balance sheet to describe what people were actually buying, and the assets were fully described. So that's kind of, balance sheets are a management tool, and they're an investor tool, and they're used when in transactions, but they're not necessarily a tax related tool. You won't see too much tax related in our world, right? And working with moms and pops and Chuck with a truck and all those kind of things, you won't see a lot of that. By the way, I just brought on another client today who's a police officer that works off duty. and he's looking for complete bookkeeping services, just like you guys are offering. And it just comes to me, when I speak with people and say this is what we're going to do and how we're going to do it, they're glad to do it, and fees are fine. So balance sheet is assets minus liabilities equal equity or owner equity, and it's typically used as a management function. You see them mostly when you're involved in transactions and soliciting investors and things like that. The other component we didn't talk about yet is the cash flow statement. So cash flow statement is a little bit harder for me to do because it's over a period of time. But what you end up with is January, February, March, April. And in January, February, March, April, what you end up with is cash flow in and out. And that's kind of how, net. That's kind of how you get it put together in a cash flow statement. So you have in, out, and net. And it flows across each month like that. Why we use cash flow statements is they're helpful when you're trying to figure it. You won't likely in a small business serving bookkeeping business, but if you go to business school, you get an MBA, or you're operating in a big firm or something, you'll be looking at cash flow statements for projections, for budget analysis. And it's an important, when I ran private equity firms, when we're analyzing where we're going to buy another company or not, or something like that, we want to look at not only how rich they are today, but we want to see that their liabilities are paid. We're going to see that off there. So what am I doing? Well, I'm going to see, their balance sheet, they look like they got a lot of assets and they don't look like they have a whole lot of liabilities. How are they doing? Well, we can also look at where their cash flow has been going, right? How has this been trending over time? And sometimes you'll see some glaring issues where you go, oh my goodness, they quit. They quit doing any maintenance on their equipment for the last year, when the last 3 years before that, they're spending $20,000 a year on equipment maintenance. So if they didn't do any maintenance this year, then it's quite likely that their equipment's about ready to wear out or break down or whatever. You can find those kind of things as you're looking at cash flow statements. Cash flow statements, okay? All right, so questions about what we're calling financial statements. Anyone? Okay, you guys are just calm down, quiet down, people. You're too excited tonight. Okay, let's talk about tax accounting. This is where we're getting into our world, tax accounting. There's a phrase that we're going to use pretty often in tax accounting. The phrase is revenue. What does revenue mean? What does revenue mean? Go ahead, tell me, somebody. How about this? Can you compare and contrast for me the difference between revenue and profit? Revenue is basically money. I think you're all scared because you don't want to be wrong, but I hope you get that I'm trying to be tender and kind. Revenue is money. And the reason we use the term revenue is because it may come in all kinds of ways. It might come in cash. It might come in promissory notes. It might come in trades. It might come in stock. There's all kinds of ways, but it's anything that's generated, anything that's coming into the company is revenue. And one phrase we're going to get to that's going to be an important phrase is going to be startup costs are pre-revenue, right? We'll get down to that. So I'm defining revenue up here so we can get the idea of what's pre and post revenue. Revenue is when you start making money, and that doesn't mean net income. It doesn't mean money in your pocket. That means when your business starts getting some money come in exchange for a promise or a service or a product. Okay, what's a deduction? What do you guys think a deduction is?
Something you don't have to pay taxes on?
There we go. There we go. I like that. That's good. So you don't have to pay taxes on. So, all right. So if you don't have to pay taxes on something, how is that different than a tax credit? What's a tax credit? So a credit pays the tax. I'll give you an idea. So let's say you made $10,000 and you had minus $5,000 in deductions. So what's this next line called? Called net what? What's the next word here?
Net profit?
Thank you very much. Net profit. Okay, so you made net profit of $5,000. Some people just call it net. Okay, so your deduction is $5,000. Net profit is $5,000. And let's presume for the purposes of this argument that we've got a 15% tax credit. Or excuse me, 15% tax bracket. I shouldn't have done that. I think that's 750 bucks, isn't it? Yeah, is that right? I think I'm right. Sometimes I get those weird digits weird. Yeah, so you got 750 bucks in tax. Okay, so your deduction was $5,000. That means you didn't pay. It's not that you didn't pay $5,000 in tax. It's that you avoided paying tax on $5,000. You see the difference? And in a 15% tax bracket, the tax on $5,000 is $750. So $5,000 in deductions gained you $750 in your pocket. Anybody have comments or thought about that? $10,000 in gross income. $5,000 in deductions means that you have a net profit of $5,000. You're paying tax on a 15% rate, so you have $750 in tax, right? Now, in contrast, a tax credit pays the tax. So if you have if I have a continuing in this situation, a $500 tax credit, now I would take that $500 tax credit and my net tax after tax credit would be $250. So which is a stronger, more valuable thing for you, a tax credit or a tax deduction?
Tax deduction.
Tax deduction is good, but a tax credit will pay the actual tax. And so a $500 tax credit is actual, typically dollar for dollar. We like tax credits. Those are good things. Tax credit pays the tax. $500 tax credit you could actually use to pay off $500 of that $750 tax, literally avoiding $500 in total credit. There's another thing called a refundable tax credit. Refundable tax credits can allow you to actually get a refund. Let's say that you had a $1,000 tax credit here. $1,000 tax credit would means that you've got a net tax of $250 or a $250 tax refund if the tax credit is refundable. And in the tax code, more and more current leadership is playing around a lot more with using the IRS as a social service agency to pay money back into people's pockets. And so we'll see tax credits becoming more and more popular in order to accomplish that. Okay, so tax credits pay the tax, deductions avoid paying on the tax amount. And I want to get to some other things. Allowable expenses, special expenses, we're going to get there. I've got just a couple minutes more. But the piece I really want to make sure we cover before we run out of time, and we're just out about time for tonight, is allowable expenses. The IRS basically says that you can deduct, as a business, you can deduct all of your expenses as long as, one, they're ordinary to the type of business you're involved in. Rarely will you run into a non-ordinary business exemption. Rarely. I I don't know if I've ever seen it. Secondly, is that they're necessary to the business. And I'm going to add a third piece, which is not the IRS, but I think the courts would uphold they need to be reasonable. So ordinary, let's ignore it. You're not going to run into that. I mean, you know, you don't see a lot of real estate agents out there buying up, you know, CAT scan machines or something. And that's where you would see that. It's just way outside the scope of their business. It's not ordinary to their business. But necessary is a term that I really want to introduce you to. And so I'm going to bring over the IRS page itself. Can you guys now see this IRS webpage?
Yeah, we can see it.
Okay.
Yes.
So this is the IRS page. It says deducting business expenses. I'd encourage you to go visit that someday and read through it, get used to it. So this is what can I deduct? And what I want you to do is get the idea of how we're going to define the word necessary. This is to be deductible. Business expense must be both ordinary and necessary. An ordinary expense is one that is common and acceptable in your trade or business. You rarely see that as a limit. A necessary expense is different than the street definition. Do you guys get that there's legal definitions that are different than street definitions? Do you guys get that? That sometimes the courts or the laws or the Congress or whatever define something quite different than we say things in the street. Does that make sense? Legal definition versus street definition. Is everybody tracking me on that?
Yeah.
So give me an idea of what, if you're telling your kids something better be dang necessary, what do you mean?
It's absolutely required.
Absolutely required, right? So, you know, your daughter comes, she says, Mom, I need $20 for the school, blah, blah, blah. And you're going to say what? Is that necessary?
Yeah.
Right? And it's not like maybe kind of. I mean, hey, we're tight. We don't need to be throwing $20 where it's not necessary. But the IRS used necessary as a definition for years, and the courts just beat on them for it. So eventually the IRS has kind of adopted the court definition. So let's read this. A necessary expense, according to the IRS, not in mom and dad language like we just had, but necessary according to the IRS is one that is helpful and appropriate for your trade or business. Helpful and appropriate. And then it goes on to say, an expense does not have to be indispensable to be considered necessary. A necessary expense, according to IRS definitions, is one that's helpful, right, and appropriate for your trade or business, and an expense does not have to be indispensable to be considered necessary. Now, does it have to be absolutely helpful and absolutely appropriate and absolutely indispensable, or kind of helpful, or kind of appropriate, or kind of indispensable? And I'll give you an example. We operate in the same world with the IRS that Boeing up in Washington does. They make I'm making this up, right? But they make a $2 billion airplane and it never flies. Do they get to deduct the expenses of research and development and manufacturing and labor and supplies and materials and overhead for a $2 billion flop? Do they? Yes or no?
Yes.
Well, was a non-flying airplane helpful to Boeing? No. Was it appropriate for the business to build an airplane that doesn't fly? No. Was it indispensable for Boeing to make an airplane that doesn't fly? No. Right? So you have to kind of put the word kind of in front of. A necessary expense is one that is kind of helpful, expected to be helpful, anticipated to be helpful. You see where I'm going?
Yes.
It's not ironclad, absolutely has to be must, right? It is expected to be helpful, expected to be appropriate. It does not have to be indispensable in IRS language to be necessary, right? And so I thought that was really, is that helpful for you guys? Does that open your eyes a little bit?
Yes.
Yeah, okay. Because this has come right off their website. And you know, I'm going to invite you to come back to the website and look at it some of the time. So ordinary, necessary, and reasonable. The last piece I want to talk about is when you're doing costs, we're going to run out of time here in a minute. Startup costs, pre-revenue. You can only expense startup costs after pre-revenue. After their revenue. If it's before revenue, they're considered startup costs, and they have to be capitalized. They can't be expensed. Capital expenditures, you know, putting on a major roof, building a building, buying a big piece of equipment, you can't deduct those in direct expenses. You've got to capitalize those over time. Restaurant meals, we want to be able to define those this year differently. Restaurant meals this year, that are for business purposes are 100% deductible. Non-restaurant meals are 50% deductible. So we want to special treat restaurant meals. Tax credit expenditures. Expenditures under the American Disabilities Act and for research and development purposes have specific tax credits associated with them. We want to make sure and track those separately and independently. And business use vehicle miles, we want to track those independently and separately. We're going to run out of time, so I'll go ahead and post your assignment up on the top of the page tonight. Appreciate everybody joining me. We'll be having next week. I fully expect us to be diving into the software and having a great time there. So I'll put a couple of assignments that I think will be helpful for you guys. And we're down to about 2 minutes. Does anybody have any questions that you'd like me to answer before we go?
Yeah.
Okay. Are you getting value? Do you feel like you were introduced to something helpful tonight? Do you feel like you could, if you understood these terms and such, would it have you feel more confidence in your practice?
Yeah, a lot of these things I've been doing, but I didn't have the name for them. So
Yeah. So if you run into somebody else, you're talking to somebody, I would encourage you to become more familiar with these terms so that, you feel like you're in your skin of your profession rather than outside. A lot of it's not essential, but it'll help you just feel better about where you are. And we'll continue to work on these. The idea is for everybody to kind of get up and going over the next couple of weeks, and then we'll be coming back with Q&A and what do I do about this and actual working on your direct business activities. Okay. So this week I intended to have everybody diving into software, but I want to make sure that our software provider is ready for volume and that they can hit that and all that kind of stuff. So next week we'll expect to be diving into the software. Your mind's going to be blown. It is such a time saver.
Larry,
And,
what's the
and we'll
name
go
of
from
the
there.
software?
Well, right now it's called Ferris Accounting, and I think we're going to end up calling it Bookkeep It or something like that. It's an independently developed software just to help you guys save time and money.
Oh, that's great. Okay.
Yeah, the idea is QuickBooks is very expensive and difficult to train to. So what we've done is we're just making a piece of software that is, I think, better in many ways, but much more transparent and easier to train to and a whole lot cheaper. So that's where we're going. Okay, guys?
All right. Thank you.
All right. Thanks, everybody. Have a great night. We'll see you next week.